Okay, good morning. Today we are going to finish up Chapter 6. It's about inventory. We have a question up here, so you'll want to get signed into Learning Catalytics. I'm going to talk about this question in a minute. And I want to remind you as you're answering the question, FIFO means first in, first out, meaning your newest units, your most recent units, your oldest units. First in, first out means you're selling your oldest units first. If you sell something, it goes into expense. Okay? So FIFO, and we'll come back to this question. We're not closing it quite yet. Before we do, Chapter 6 homework is due this Saturday. Chapter 6 homework, you're going to have to go step by step on it, and it's going to take a little more step-by-stepness, if that makes sense, than some homeworks, because it's very structured. You have to do it. You have to do inventory in a certain order, and it has to be done a certain way. That said, what I did last night is it occurred to me that I've recorded step-by-step videos on how to do all the homework, including what we're doing today in class. So last night I emailed out all the links for the homework problems, and then I emailed out, there was one other one where there were a couple extra questions that aren't on the homework. So I emailed those links out. Even though we're doing a lot of that homework in class today, I did it for two reasons. Number one, when you're doing the homework, you can click on just the video you need, not having to go back through the whole class to figure out where it is. So as you're doing the homework, if you need help with the homework, you have the step-by-step video that I emailed out. And the other reason I did it is because I can go really slowly today, step by step. I don't have to rush because I know you have everything, whether we do that exact homework problem in class or not. So, and you don't have to watch those. Those are there just in case you want them, but I did email those out yesterday. They're under announcements on Blackboard. You can get to them that way as well. Okay, so back to this question. The FIFO method assigns the most recent inventory cost to expense. So this question is saying FIFO has the newest unit being sold first. That's the statement. FIFO actually says your first units are the first ones out. So your oldest units are the first ones sold. So another way, so this is obviously false, but there's this little chart here. When you're asked a question like this, our way to remember is we have this chart. I'll have it again later in class. We'll see it again today. But cost of goods sold or expense. Under FIFO, we sell our oldest units first. Under LIFO, the newest units are sold first. Ending inventory, the asset, under FIFO is your newest units. Under LIFO, it's your oldest units. If you memorize just FIFO or just LIFO, just memorize one of them, the other one is exactly the opposite. Okay, again, if you've answered this question, do check your answer to make sure you've answered it right, because I do have right now I've got 6% incorrect. So just make sure you're not one of the incorrects here. This is false, and when we talk about FIFO and LIFO, this chart is kind of handy. So under FIFO, your sold ones are your oldest units, your ending inventory is your newest units, and then LIFO is going to be exactly opposite of that. And we're going to see this chart coming up again in a few minutes, but I put it on here because it was a nice visual to go with this question. Okay, I'm going to leave that question open for a minute or so. I won't be announcing when I close it, but if you just joined us, make sure you get logged in and get the question answered. So next, okay, we're doing Chapter 6, and just a reminder, as we do things today, beginning inventory, abbreviated BI, ending inventory, EI, and cost of goods sold, COGS. So we had those abbreviations on Monday, just a refresher because we'll probably see some of those today. Okay. And also in the refresher category, this comes from Monday's slides. I just wanted to point it out again, that those are the important like formulas or setups for when we're doing these inventory problems. That our ending inventory plus our number of units sold has to equal our beginning inventory plus our purchases. Okay, and again, this was Monday, so we're going to keep referring to that, and we'll see it again coming up. Okay, so new stuff for today, or just emphasizing stuff from Monday. Inventory is an asset. It's a current asset. You may want to note current asset because we expect it to be sold within our operating cycle, within a year generally. So inventory is a current asset. Cost of goods sold is an expense. So inventory shows up on the balance sheet. When we sell it, it turns into cost of goods sold and shows up on the income statement. Okay, so we have inventory as an asset, cost of goods sold is an expense. Again, these slides are on, the PowerPoints are on Blackboard. So inventory is an asset, a short-term asset, cost of goods sold is an expense. Okay, so this is Exhibit 6.2 in your book. When we talk about inventory, inventory goes on the balance sheet. This is a partial balance sheet. It goes on as a current asset, and in this particular example, Family Dollar Stores, here's the setup on the Family Dollar Stores, has in stock 300 towels that cost $3 each, and then they sell the towels for $5 each. So on the balance sheet, inventory is a current asset and it's carried at its cost. So in this case, we're told the towels cost $3 each. So they have 100 towels at $3 each. So that's the balance sheet. The income statement, these towels show up in two places. The sales of the towel, we sold 200 towels at $5 each. So when we talk about sales revenue, it's our selling price, what we're selling them for. And then the cost of goods sold, the 200 towels we sold, it's the cost. The $3 cost goes on under cost of goods sold. And then we calculate the line after that. Sales minus cost of goods sold is gross profit. You want to know that too. So that's okay. So this is something to note too. Sales minus cost of goods sold is going to give you gross profit. So sales minus cost of goods sold is gross profit, also known as gross margin. Gross margin is the same thing as gross profit. So sales minus cost of goods sold is gross profit or gross margin. You might see that. You'll see it on a financial statement. Okay. So sales minus cost of goods sold is gross profit or gross margin. Now to follow up on this, okay, sales revenue is based on the sales price of the inventory, what we're selling it to our customer for. So sales revenue is based on the selling price. Selling price is what we are selling it for. Cost of goods sold is based on the cost of the inventory sold, what it cost us to purchase. Inventory is based on the cost of the inventory on hand. So we've got selling price and we have cost. In the towels example, we're selling the towels for $5. It cost us $3. Okay, so we have sales revenue based on the sales price, cost of goods sold, and inventory based on the cost. So in this example, Family Dollar store, we sell the towels for $5. That's the selling price. That's our sales revenue. They cost us $3. That's what cost of goods sold is going to be based on, and that's what inventory is going to be based on. Okay, now, again, continuing this idea of what's in inventory. Inventory, we consult our accounting records to find out what we have online, what we have available. We also will do a physical count at the year end to make sure that what we think's in stock is in stock. There's various reasons they might be different. The physical count might be different. If inventory has been stolen, of course it won't be there. If it's been lost, sometimes I've noticed at the grocery store where they're supposed to scan each item, and I understand why they'll do a multiple of whatever, but it's actually different items, different flavors, and so the inventory count will be off, and that's why they do inventory. Consigned goods. Okay, consigned goods are goods that your company doesn't own that you're holding out for sale. As an example, at McKay Bricker, downtown Kent, they had these squirrels that are like a foot high, real heavy, and I went to buy it, and she took my money and she got an envelope, and she put it in the envelope and wrote a name on it, and I was asking her about that. And here the university gives McKay Bricker a certain number of these black squirrels, and McKay Bricker doesn't pay for them, but they display them, and then when someone buys the black squirrel, they remit the money to the university, and presumably the university gives them some cut of it. But those squirrels that McKay Bricker has, they haven't paid for them. The university still owns them. They are simply selling them for the university. So those goods are considered to be on consignment. Those squirrels would not be on McKay Bricker's inventory. They would be on the university's inventory because the university owns them. So you don't, if you have goods on consignment from someone else, they're not on your balance sheet. If your inventory, if someone else is selling it for you, that inventory you still own. So you have to be careful who owns it. In transit goods, we have to worry about if it's FOB shipping point or FOB destination. We include inventory on our balance sheet if we own it. So if it's FOB destination, then we own it until it gets to its destination. If it's FOB shipping point, we own it until it leaves our dock. So consignment inventory does not. Consignment inventory is on the balance sheet of the company that has the title to it, that actually owns it. Okay, so got a question here. Okay, inventory is presented on the balance sheet at the selling price of the item, true or false? Okay, so this is the balance sheet. This is our inventory. This is where we're saying, here's what we own, okay? Selling price is what we sell it to our customers for. So just clarifying, the selling price is a very specific term. It's what we sell the inventory to our customers for, that price. Okay, I'm gonna leave this question up, but I'm gonna flip back a couple slides here. I guess this is the one I want. Okay, so what we're talking about in this question is inventory on our balance sheet. So the Family Dollar store, the towels sell to our customer for $5. They cost us $3, assuming us is Family Dollar store. So on the balance sheet, where inventory is always on the balance sheet. Inventory is going to be shown at our cost. We show inventory at our cost. So when the selling price of these towels is $5, on the balance sheet, inventory is shown at cost. Two very specific terms that might sound the same to you initially, but they aren't. They are very, very different terms. Selling price is what we sell to the customer. So selling price will be the $5 in this example. Cost is what it cost us. So when we talk about the balance sheet, our inventory is always carried at cost. We don't value it at what we're going to sell it for. That would be all kinds of bad because we can manipulate it. We have it on the balance sheet for what it cost us. Okay. So back to our question. We're up to 83%, correct. Okay. Again, so looking at the question, because I'm going to close it soon, but again, this is meant to be a huge hint. This is the balance sheet. Inventory is on the balance sheet. Inventory is carried at cost. Cost and selling price are not the same thing. Cost is what it cost us to buy it. Selling price is what we're selling it to our customers. If we go further here, the income statement is where you see the selling price show up as sales revenue. Okay? Okay, so this one, okay, I'm going to close it in about 10 seconds. Okay, and again, that is false because we show it on inventory on the balance sheet at the cost of the item. The cost is not the same as selling price. The selling price is what shows up on the income statement as revenue. Okay, so this is just a refresher. I'm not going to pause on this, but this is from Monday, our two basic inventory formulas, and beginning inventory plus purchases always has to equal ending inventory plus cost of goods sold. Okay, there's two types of inventory systems, and you just need to know what the two words mean. There's perpetual and periodic. So perpetual inventory systems. Perpetual inventory systems used for all types of goods. We keep a running total of our inventory at any given time, and inventory is counted at least once a year. Basically, perpetual inventory system, we've probably got a computer system running that's always, as we sell things, we scan them, they're taken out of inventory as we get things in, they increase inventory. So perpetual inventory system is when we're using a computer system to keep a running record of inventory. Okay. So that's perpetual inventory, and that's typically what we're going to do in this chapter. But you also need to be aware, once in a while you'll see somebody say that they have a periodic inventory system. With perpetual, by the way, perpetual inventory system, you have a computer system keeping track. You know, you scan things, they go out of inventory, things come in, they're added. So at any given time, you have an up-to-date inventory. You still have to do a physical count at least once a year. You're doing that to make sure errors have not crept in. Sometimes the scanning can be wrong. Sometimes quantities are wrong. Sometimes inventory disappears for other reasons. So there is still a physical count at least once a year, even with a perpetual inventory system. Perpetual inventory system, you know, at any given time you can look and it will be there. As opposed to a perpetual, a periodic inventory system. Periodic inventory system typically used for inexpensive goods. It does not keep a running total, so it's kind of an older system. but at least we need to know. We count it at least once a year. Both of them we count at least once a year. But periodic, we don't update our inventory records. We'll do that occasionally. This would be used for very inexpensive items with not a lot of dollars involved. But typically we're going to be using perpetual, where inventory records are continuously updated. Okay, so perpetual inventory. When we talk about the cost of our inventory, the cost of our inventory is the cost of what we spent to purchase it, the invoice, but it's also freight in. Freight in is the amount of freight to get the inventory to us. It subtracts purchase returns, subtracts purchase allowances, and purchase discounts, giving us the net purchase cost. You know, the numbers off to the side don't mean anything. It was just there to show you if they're being added or subtracted. So the purchase price of inventory plus the freight in, which is the cost to get the inventory to us, subtract purchase returns. These are things we're returning because they're not suitable. Purchase allowances for some kind of damage they're giving us an allowance for. And purchase discounts, we have purchase terms like 210 net 30. We're getting a discount for paying early. Yes, I'll get there, but yeah. Okay, so the top item, purchase price is the invoice price that we paid. Freight in is the cost of getting the inventory to us. Purchase returns, again, are pretty intuitive. They're what? Things that we returned because they weren't right for our purposes. Purchase allowance. If we buy something and maybe it has a dent in it or something, and we call up the company and say this has a dent in it, sometimes they'll say, oh, we'll give you $100 off if you keep it. So that would be a purchase allowance. Is there some kind of damage to it? We're keeping it, but they're giving us a reduction because of that damage that maybe occurred in shipping or when they were unloading it, but we get some kind of reduction for that. And then purchase discounts, if we, just like when we were talking about sales discounts, purchase discounts the flip side. A purchase discount is we buy something on credit and the seller says, here's terms at 210 net 30. 210 net 30 means that we can take 2% off our invoice if we pay within 10 days. So that would be a purchase discount. So most of the transactions we do, we're not going to have all these things. They're kind of assumed in it for most of the homework. So we're not doing a separate journal entry for each one of these things. So we're going to usually look at the net. Okay, so now we're going to do a couple journal entries. Just as a reminder, these slides are on Blackboard if you need to go back. So why am I starting with a purchase return? Hold on, I think I'm going to go in a different order. Okay, so if you have the slides, these are, what? I know, but if the slides, the first journal entry I have for some reason is a purchase return. We're doing a purchase first. So let's say we purchased $1,000 in merchandise. So if we're going to do a purchase what we're going to see in a journal entry is we're going to debit inventory and we're going to credit accounts payable. So that's just the basic purchase of inventory. And we've seen that back in chapter, now it seems a few chapters ago, back in the chapter 2, transactions. We're purchasing inventory and asset, and we're giving up, we're adding a liability. Sometimes we can purchase inventory for cash, but here we're purchasing it on account. So we're going to debit inventory and credit accounts payable, so we're increasing our liabilities with this. Okay, so we've purchased $1,000 of inventory here. Now let's say we purchased it on account. Let's say the terms are 210 net 30. Okay, so to record the payment for that merchandise, if the terms are 210 net 30, what we're going to be doing is, first of all, when we pay for this, we are going to have to wipe out the accounts payable. We're paying the entire invoice. So we want to wipe out that accounts payable that we just wrote. So we're going to debit accounts payable to liability. We're debiting it to get rid of it because we no longer owe it. We're paying it off. So then our credit to cash will be the actual cash we're paying. They're offering a 2% discount, so our cash is going to be $1,000 minus 2%. So our cash here, inventory? Yeah, I guess we will. Okay. Okay, our cash here will be $980. You can do either of the credits first. So the credit to cash will be to $980 for $980. How I got that 2% of the $1,000 is our discount for paying early. And then the difference, the credit, goes to inventory because it reduced the cost of inventory. Okay, and then quick question before we go on to the next section. An inventory system that uses computer software to keep a running record of inventory on hand. Okay, an inventory system that uses computer software to keep a running record of inventory on hand, that's going to be called a perpetual inventory system. I'm going to close this in about 10 seconds, so make sure you get your answer in. Okay, so a perpetual inventory system. Perpetual is what we're using throughout the chapter. Now, we're going to get into the differences between the various inventory methods. We just went over cost. Okay, so we have 4 inventory methods, 4 cost flows. Okay, now what inventory method we choose is not dictated by our product with the exception of specific unit. Okay, so the 4 inventory methods, we talked about this on Monday, but just to review the 4 methods, specific unit is unique items. So this is the one method that is dictated by your product. Okay, you can only use specific unit if your product has unique items, things with serial numbers, typically big dollar items, so that it's worth tracking individually. You are not going to use this if you're selling t-shirts or towels or shoes or things like that. We're talking airplanes, cars, custom jewelry, things like that. So specific unit is the only one of these that is dictated by the product, okay? So you can only use specific unit in very narrow circumstances. Now the next 3 methods, are weighted average or average, but whenever we say average, we're referring to weighted average. So average, FIFO, LIFO, those 3 methods, you can use with any product. Okay? When we're talking about choosing an inventory method, we're talking about applying a consistent assumption about the cost flows. So we want to use the same method consistently. We don't want companies manipulating their income based on what inventory method they choose this year. You're going to choose a method and you're going to stick with it. You can choose a method that does not reflect how your goods are moving because it will work out over time as long as you use the same method. So companies are free to choose any of the three. They can't use specific unit unless their inventory is identifiable. But the other three, they can choose which one. Now, that said, I'm going to give you examples of products that move like this, but that doesn't mean you have to use your this method if you have that product. So your choice of inventory method is an accounting choice only. And it's saying we are going to consistently apply these assumptions about what units are in inventory and what units aren't. So average cost, just a rule of thumb, average cost, you're taking your total cost of goods available, dividing it by the total units available. Okay, so that's average cost, weighted average cost in a nutshell. Okay, so next up, FIFO, first in, first out. Our first ones in, our oldest ones, are sold first. In LIFO, our last ones in are sold first, our most recent. Okay, now what I'm going to do is on this slide, I'm going to give you an example of a product that would be sold like the inventory method, but other than, okay, the first one, specific unit. You can only use it for products that are unique. So here I have airplanes, because they are unique. They have serial numbers. They're certainly high-ticket items, and they certainly track those individually. Okay, so specific unit is different from the other three in that you can only use it under a very narrow set of circumstances. Okay, now the next three. I don't care what your product is, you can use any of the three. But I'm going to give you an example of a product that kind of you can visualize this inventory method. Cereal. We make cereal. They have big batches of it. So they're going to make a big batch of it. They're going to take the total cost of that cereal, divide by how many boxes of cereal, and that's how they're getting their cost per box. Okay? But cereal manufacturers do not have to use that, but that's an example. Now, FIFO. If we think FIFO is you're selling your first units in or your first ones sold, okay? An example of that would be how they sell milk. When you put milk, and they put milk in the cooler, they're pushing the oldest milk out first, right? Because they put the more recent milk in the back of the cooler. So you're selling your oldest milk first, and you do that because if you left your oldest milk in the back of the cooler and just kept putting your new milk out front, your old milk would be spoiled very rapidly. But if you keep selling your most recent milk or your oldest milk first, that represents how FIFO is done. Now, a milk distributor can use any inventory method for milk, average cost, FIFO or LIFO, but that kind of represents how we're doing the cost flows, the assumption we're making. And then for LIFO, a good way, this is a salt dome, getting ready for winter and salt on the roads. Salt domes, the way they use salt is LIFO because you have to dig the salt off the outside of the dome, and that's the most recent salt. So the salt that was dumped earliest in that dome is down in the bottom of the center, and you can't get to that. Okay, so your oldest stuff under LIFO is going to be sitting there in inventory. You're selling the most recent stuff. So a salt dome and milk kind of represent these cash flows. But again, a salt producer can use any of those inventory methods. The big thing with accounting is that you make a choice about your inventory method, and you say, this is the assumptions I'm using, and I'm going to apply them consistently, and it'll work. So now what we're going to talk, we started off class with this. If you did not get it, you'll want to refer back later. But this is a nice way, kind of in a nutshell, to memorize what's going on here. FIFO, the oldest units go to expense. The asset or ending inventory is our newest units. LIFO, our newest units are expensed, and our oldest units are in ending inventory. I do recommend you memorize that, and maybe you just memorize the FIFO column, because the LIFO is going to be exactly the opposite. Okay? Okay, now, I just sent a question out. I want to talk about this question because you should be able to do it. We'll talk about how you would tackle it. So this question is, a company has beginning inventory of $40,000 and purchases during the year of $110,000. Okay, so we know our total cost of goods available, right? So your total cost of goods available is your beginning inventory of $40,000 plus your purchases during the year of $110,000. So those two added together, this is something you want to probably write down in the margin so you can do this problem. So your beginning inventory of $40,000 plus your purchases during the year of $110,000. Those combined are $150,000. So that's your cost of goods available. That's your total cost. Now, reading on, the beginning inventory consisted of 3,000 units, and 7,000 units were purchased during the year. So the total number of units you had were 10,000 units, right? The 3,000 plus the 7,000. So now what's our weighted average cost per unit? So this is using the average method. And again, when we see average cost, it's weighted average cost. So you're going to take your total cost of your goods available and divide it by those total number of units. Okay, what do we have here? Again, you want to get your answer in. So you're taking your beginning inventory of $40,000 and purchases of $110,000. So you have $150,000. That's your cost. You're going to divide that by the total units. So you have $150,000 divided by 10,000 units. So $150,000 divided by 10,000 units is going to give you that average cost per unit. So if you didn't get that, it is the 40,000 plus 110 divided by the 10,000. So that's $15 a unit is your average cost. So then if you were given the number of units sold, you could multiply by the 15, or the number of units in any inventory, you'd multiply by the 15. So I'm going to close the question in about 5 seconds. So we've talked about the FIFO, LIFO, weighted average in specific units. Specific unit is used in specific cases, so that's off the table. Weighted average is somewhere in between FIFO and LIFO. So let's talk about why companies would choose FIFO and LIFO, okay? So remember, average cost is going to be in the middle between those two. So when inventory costs are increasing, so let's assume we have inflation. And we typically do. We have, usually inventory costs are increasing unless you're dealing with technology, and then inventory costs will be decreasing, so it's the opposite. But let's assume inventory costs are increasing. And this is an exhibit in your book too, with more detail than what I have here. You're probably not going to be able to write all this down. Again, I would refer you to the notes to get the whole thing, or to snap a screenshot of it. So, FIFO. FIFO, cost of goods sold, is lowest, meaning the expense under FIFO is lowest because it's based on oldest cost. Gross profit will be highest under FIFO. FIFO ending inventory is the highest because it's based on most recent costs. LIFO is exactly the opposite. So this is Exhibit 6.8 in your textbook. I would either grab the PowerPoint slides, take a screenshot now or a photo, because this is something you'll see again. And again, there's a couple things in this chapter to memorize. One of them is FIFO, LIFO, the cost of goods sold, and the ending inventory, and then kind of understanding that if your expense is higher, then your net income is going to be lower. Okay, now on that same exhibit, there's a part that says, well, what happens when costs are decreasing? So if costs are decreasing, everything's going to be the opposite. So if you would memorize this kind of effect here, and then you see costs are decreasing, and it's going to be exactly opposite of that. So that would be the other half of this panel. I'll include it here just for completeness, that just showing you that it's there, and it is in the slides. But there's a reason. Now when we look at this, when inventory costs, let's go with inventory costs are decreasing. Go back. Inventory costs are increasing. This is inflation, right? So typically costs go up over time, ignoring this little pocket of technology. But typically we have inflation, costs increase over time. Costs increasing over time under LIFO, the cost of goods sold is going to be highest because LIFO has the most recent cost on the income statement. LIFO says our most recent units are sold first. So we are assuming our highest costs are on the income statement. So LIFO is going to make our income lower if costs are going up. So if we, okay, when prices are going up, let's talk about why a company would choose LIFO. If you choose LIFO and there is inflation, your net income is going to be lower. And why is that? When prices are rising, LIFO will result in the lowest taxable income. Okay? If you have the lowest taxable income, it results in the lowest taxes. So if your income's lower, you pay less taxes, and then you have if you pay less tax, you have more cash available, so then you can take the cash and invest it in something else and earn money on that savings. And so that's the idea behind why you would choose LIFO. LIFO has a tax advantage, basically, when it comes down to it. Under U.S. tax code, LIFO has a tax advantage if costs are increasing, if we have inflation. Okay, so comparing cost of goods sold. LIFO will give you the more realistic net income figure. FIFO will have a more realistic balance sheet. Okay, so LIFO is going to give you a more realistic net income. Okay, FIFO is going to give you a more realistic value on the balance sheet. And then weighted average is going to be somewhere in the middle between those. Something else to note, under international financial reporting standards, so U.S. GAAP, you can use weighted average, you can use FIFO, you can use LIFO. Under international financial reporting standards, LIFO does not exist. So companies can't use LIFO. There's continual talk in Congress about disallowing the LIFO method for inventory. The reason they're doing this is it's a big revenue. It would get a lot more revenue for the government if they were to eliminate LIFO, and companies would have to pay a lot more taxes. So that's why if you ever hear discussion, once in a while in the news, they'll be talking about inventory methods for tax code, and that's what they're talking about, because LIFO saves company taxes typically. You cannot just change methods from one method to another. You can change methods, It has to be rare, and you have to disclose it and do a lot of what-ifs and show what it would have been had you used this other method. So companies cannot switch year to year to year. You pick a method, you stick with it, and consistently apply it. Okay. Okay, on this one, I don't think the blank lines aren't showing up, so look at the screen to answer this. Sales revenue is based on the blank price of the inventory, while cost of goods sold is based on the blank of the inventory. Sales revenue is based on the, we said selling price. I will tell you selling price and sales price are the same thing. So there I've just eliminated answers A and B for you. So now you're down to C and D. So the correct answer is not A or B. Sales revenue is based on the sales price of the inventory or selling price of the inventory, while cost of goods sold is based on the blank of the inventory. Okay, so cost of goods sold. So we said that it can't be A or B. Sales revenue is based on the sales price of the inventory or the selling price of the inventory. Okay, and cost of goods sold is not based on the selling price of the inventory. So we've just eliminated another answer. So you have about 10 seconds to get your answer in. I'm going to be closing it. Okay, so now we're going to go to a homework problem. Again, I sent you out last night links to step-by-step videos for each individual homework problem so that if you need it while you're working on it, you can stop and pause it and you don't have to find it on this recording. But we're going to go through them here. So we're doing a problem where we're using average FIFO and LIFO methods. It says that City Copy Center sells laser printers and supplies. Assume it started the year with 100 containers of ink, and it tells us the cost, the average cost of the ink, the FIFO cost, and the LIFO, because they'll be different. So it's telling us our beginning inventory is 100 units, and then here's the 3 different costs, and we'll show you what we do with those. During the year, they purchased 700 containers of ink at $9.90, and they sold 600 units for $19.50 each, and it has operating expenses, which is kind of a new twist thrown in for us, but we'll get there. So we're supposed to prepare the income statement for the current year under average FIFO and LIFO inventory costing methods. So what we're going to be doing here, the first thing we need to do is just to reiterate that how many units did we sell? Well, it tells us how many units we sold, but we can put it in the format what we were looking at before. We have our beginning inventory of 100 units, plus we purchased 700, minus the ending inventory gives us sold. Now, what's our ending inventory? I would have to back into that. My ending inventory is the 100 units plus the 700 I purchased minus my sold. So I have 200 units and ending inventory gives me sold of 600. So basically I filled it in because I want it in this format. When we're going to be filling in the numbers, I want it to end up with my sold. So I'm just proving out the numbers in the problem work. A better question I could have put up here was how many units are in ending inventory. Ending inventory is the 200 units. How do I know that? I know that by taking the purchases, the beginning inventory plus the purchases minus the sold. Okay, so now this what I have on the screen right now, I'm going to use that same setup for average cost, and then I'm going to use it for FIFO, and then I'm going to use it for LIFO. So I'll have columns for each, but on my screen you're only going to see this one. So this same setup, if you can write and leave a column for each of them, you won't have to keep rewriting everything we've got on the screen. So we're going to start with the average cost. So we're doing average cost right now. So we are calculating the cost of goods sold under average cost. So under average cost, my beginning inventory, it told me average cost was $8.30. So $8.30 times 100 units in beginning inventory, purchased 700 units at $9.90. It told us that that's going to be the same for all of them. And then my ending inventory, we'll get there. So I'm going to have beginning inventory $9.30 purchased. That's my total cost of goods sold. That's my total cost of ending inventory plus sold units. Okay? Because I know that my beginning inventory plus my purchases together have to equal ending inventory plus my sold units. Okay, so that's what I know so far. You can easily get to that point, but again, to do this problem, you have to kind of go at it at a way. You don't go for the answer right away. You have to do some work ahead of time. So this is average cost. I know under average cost, my total cost, actually under all three methods, the total cost of ending inventory plus sold units is $7,760. Okay, so under average cost, then I'm going to divide that by the total number of units. And the total number of units in my beginning inventory plus my purchase, the 100 plus the 700, I'm going to take the 7,760, divide by 800 units. Those are my beginning inventory plus my purchase, and I'll get $9.70 per unit. This is my average cost. I'm doing the average cost. So I had to get my total cost, and I had to get my total units available. So now I have my average cost of $9.70 per unit. Okay, so I know my average cost. So then this exercise specifically asks me for the income statement. On the income statement, I have sales revenue and I have cost of goods sold. My cost of goods sold is the number of units I sold times the average cost per unit. So I sold 600 units at $9.70 or $5,920. Okay, so now I have enough information. I'm not going to figure out the ending inventory at this point. I have enough information to do my basic income statement under average cost. So what I'm going to do is I'm going to leave this screen, and I'm going to, you would want to set up another section in your notes that has the basic income statement on the left, and then you want to have columns for all three methods, for the weighted average cost, the FIFO, and LIFO. Okay, so at this point, you should have the 5,820. So our income statement, this is what you need to write down. You're going to need, we're going to be filling out all the columns, but we have for an income statement, this is our income statement format. We have sales revenue minus cost of goods sold equals gross profit minus operating expenses. And so our sales revenue is the number of units we sold, which is given to us. We sold 600 units for $19.50 each. So the sales revenue across all three methods will be the same. Cost of goods sold is what we just solved for, the $5,820. And then our gross profit is the sales revenue minus the cost of goods sold. Operating expenses are given to us in the problem as well, and we subtract that to get our net income. So what we're going to be doing next is we're going to be doing the FIFO column, and we're going to be doing the LIFO column. Okay? So you'll be able to come back to this in your notes as we go through each of those methods that you have the two columns just waiting. And we knew we could put the sales revenue all the way across. We knew we could put the operating expenses all the way across because they are the same under all the methods. Okay, so next up then, let's do FIFO. Okay, so for FIFO, what changes is our beginning inventory is different because under weighted average, it told us back up in the top average cost $830. Well, it's telling us the FIFO beginning inventory had a cost of $8.40 each. So I'm going to take the 100 units at $840 now. So now my total cost changes to $7,770 is the total cost of ending inventory plus sold units. Now, FIFO is sold my oldest units first. So my oldest units here are the earliest ones. Whenever I see FIFO, I write down sold oldest units first. So what I'm going to do with FIFO is I sold all my beginning units. So I sold these 100 from beginning inventory. My total sales were 600, so I had to take another 500 out of my purchased. So I'm starting from the earliest and getting all the inventory I need. So I have 100 sold at $840 and I have 500 sold at $990. So my cost of goods sold under FIFO is $5,790. Okay, and then so in my income statement, I'm going to fill that cost of goods sold in, the $5,790, and then I can do the, put in the $5,790, and the $5,790 was coming from right here, the cost of goods sold. So under FIFO, we had the cost of goods sold, $5,790. Okay, so I get net income of $2,160. Okay, and then finally LIFO. And we're getting the total cost as practice because we'll use it in most problems where we have to get the total cost. But LIFO cost is $8.10 each. So we'll have 100 at $8.10, giving us $810. We add to the purchase, and we get a total cost under LIFO of $7,740. Now, LIFO is our sold units. We sold our newest units first. So we purchased 700 units. So those are our newest units. So if we sold 600 under LIFO, we'll have 600 times the 990 the purchased. So this 600 here is coming out of the purchased. And we purchased enough to cover that, so we don't have to go back into an earlier layer. Okay, so the number that we need on this page for the next one, the cost of goods sold, is $5,940. Okay, so then our income statement under LIFO is we're going to put that $5,940 here. Okay, and this will complete that problem. Now, I'm going to leave this screen, but you're going to see the same exact statement coming up here. So if you're not done writing, you're going to see it coming up, the same things coming up. Let me show you. Okay, so 6.3 continues. So here's that same statement that we're talking about. 6.3 says, let's finish the income statement by taking taxes off. And it tells us that this corporation has a 40% income tax rate. So what you do with a 40% income tax rate is you take your earnings before tax, multiply by 40% to get the tax, and then you'll subtract the tax. So this is that same income statement that we have been doing. It was just continued off the last page. And we are going to calculate income tax of 40%. Okay. And we would next, if you were going to calculate your final net income, you would subtract the income tax away. But here it says to which method, it's compute their income tax expense under average FIFO LIFO. So we took 40% to get our income tax expense. We're taking 40% of the income before income tax under each of those methods. Okay? So each of those methods, we're taking 40% of the income before income taxes. So then the question asks, it says, which method would you select to A, maximize income before tax? Well, to maximize income before tax, for question A, you would pick FIFO because cost of goods sold is lowest. The lowest expense is going to give you the maximum income before tax. And then the second requirement, the second question says, which method minimizes the income tax expense? So FIFO gives you the most income, so the method that minimizes income tax expense is going to be the one with the lowest income. So the answer for B is going to be LIFO because cost of goods sold is highest. The highest cost of goods sold is going to give you the lowest income and the lowest income tax expense. I can't read the screen. Oh, if you attend the second session, you have to answer all the questions. You can't pick and choose. You're welcome to attend the second session, but and if you don't email me to tell me you did that, you get the lowest of the two scores. That's just how it works, unless I know to watch out for it. But no, if you attend the second session, you can't attend the second session to answer a couple of questions. Okay. Okay, so now we have a question. Which of the following businesses would use the specific unit cost method to account for inventory? Which ones of these could, I guess? Could or would? So what I'm saying here, when we use specific unit, you have to have something that is unique or has a serial number, usually high ticket items. So walking through these, automobiles clearly have serial numbers. They're big ticket items. Jewelry, I think that that's a reasonable assumption too. Talking about custom high-end jewelry, make that assumption. Real estate, absolutely. Yeah, real estate, uniquely identifiable, usually big ticket. So what we're going to see here is you're going to see all of those would be that answer. So we're coming to the end of class here, and or we are at the end. And so again, I emailed out step-by-step instructions for all the homework, just like we were going to walk through it in class. So use that. Email me if you have any questions. Have a nice weekend, and I will see you on Monday.